Big linear fall from grace, this time in the automotive industry, in just the past 9 months, losing over 90% of their value. Is it warranted? Carvana, once a darling of Wall Street and just kind of used car selling in general, went from a peak of $370 a share to now $32 a share. A massive decline, right? They're worth less than 10% of where they were at their peak in August of 2021. How is that possible? You shouldn't expect for the stock market to make sense. Okay, let's just start there, right? When you have an environment where we've printed the amount of money that we've printed, you can't expect this stuff to always make sense. You have to understand we're living in a world of extremes. There is a modicum of sense to what's going on, and here's what I can scratch together. One, it's not a platform business, right? They are buying and then reselling inventory, right? They're buying used cars, maybe fixing them up a little bit. They know what to buy, they fix them up a little bit, and then they make it a really seamless and enjoyable buying experience. They've got these nice showcases, which are good marketing, elevators with all these cars, and historically they had a lot of growth. And so when you have growth, that can make up for not making money. But if you are a linear business and your growth slows and you're not making money, you're in hot water. Now, should they be as low as they are? I don't know. In Q2 of last year, their revenue was up 200% from the year prior. And they actually made, $80 million or $20 million for net income, $80 million for operating income. They made a little bit of money, not a lot, not good margins, but they had a lot of growth and, they made a little bit of money. Then you look at Q3, growth was up, but not as much. And then they lost a little bit of money. Q4, same kind of thing. It was up, but not as much. And then they lost a little bit more money. Then you look at now, this most recent quarter, Q1, compared to where growth was in Q3 of last year, where the revenue, they're basically flat, right? So that's not good. And then they lost a good chunk of money. So those are the wrong signs, right? They also missed on the guidance they were providing to Wall Street on their earnings for the past 3 quarters, and they missed by greater and greater amounts. So, you can have these high-flying valuations if you have growth. If you don't have growth, you got to show some profitability. You got to be able to make some money. And if you can't show the growth and you can't show you make money, then yeah, you get whacked pretty aggressively. That's a good thing. Should they be worth literally less than 10% of their value in August 2021? I don't know. But this is actually a good thing, frankly. In general, especially if you are a linear business, but even if you're a platform business as well, but where the platform businesses are more asset light, it should allow them to be more flexible and more responsive to the ups and downs of this kind of oscillating economy, right? What we've seen is the platform business model, because it's asset light, is able to take those shocks to the system and be able to kind of capitalize on the ups more quickly and more efficiently, and then kind of minimize and mitigate losses when you have a downturn, right? Better than the linear businesses, right? Because the linear businesses have heavier and more hard fixed assets, and the platforms don't, right? So you generally see that play out. Netflix is an example of that. Carvana, I think, is another example of that. It's hard to find a good public comp. This is an okay comp. They're selling cars. This is CarGurus. Been around for a lot longer. It doesn't have as aggressive of a growth story, right? They're not as new on the block as, say, a Carvana is. But if you look at August of 2021, they were at $30 a share. Now they're at $23 a share. So they're still down. And I mean, this is even more drastic. In March of this year, they peaked at about $46 a share, and now they're half that, right? So you're seeing a correction there, but it's nowhere near, it's called a 50% correction as opposed to like a 90 or a 95% correction, right? It's not a perfect comp, but they're both selling cars. CarGurus, asset light, platform model, and Carvana, linear, had much greater growth expectations. So there was a lot more hype around Carvana, which set them up for a bigger crash. But again, you can kind of see the bands, right, of this just much more extreme on the linear case with a lot of hype, and then just more mitigated from the platform case. If you're interested in some of that analysis, go check out some of our interviews where we had the analyst from WisdomTree come on the show and talk about the ETF that we did with WisdomTree called Platt, which is an index of all the public platform stocks. Talking about, again, in COVID, what happened with Platt a year after COVID, right? And kind of seeing how this platform index responded. Go check those videos out.